Good morning. Happy Friday. It is February the 27th, and here is what's on the agenda. Credit jitters continue. Block slashes jobs as it bets on AI, and a by-election blow for Keir Starmer.
European stocks set for very modest gains. Gains of just 5 points. But this is in the context of European stocks that are close to record highs, Lizzie. S&P futures pointing low by 0.2%. Pressure on the Nasdaq 100 yesterday, particularly Nvidia, falling pretty hard. 134 on the pound. We watch this on the political risk in the UK. And Brent crude at $71 a barrel, higher by 0.7 as we look to additional talks between the US and Iran, potentially next week. The opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. Friday, the 27th of February, just gone 7 o'clock here in London. And let's get straight into the agenda. And we start, as we have done many times, it seems, in recent weeks, with jitters coming from credit markets. There are a few different threads to pull together, though, some of them more familiar than others. So we have the story of another BDC, business development company. These are the private credit direct lenders to the software sector, or to lots of sectors, but notably to software. And that's where the market's concern has been recently. So we've got another one, an example of one of those getting itself into a little bit of trouble, decreasing payouts, decreasing value of its portfolio. This is mid-cap financial investments. So that's one side of it, and that business is overseen by Apollo. So for those who are really worried about private credit, this is another example of why you should be worried. Then we have a sort of slightly different story, but still it reflects concern around credit. And this has more parallels maybe with Tricolour and First Brands. And this is MFS, a London-based non-bank lender. But this is lending for property, so not really to do with the software story. But once again, we're concerned about where these debts end up. Do they end up on the bank's balance sheets? And do we see some kind of contagion? So in some senses, all of these credit stories add up to more nervousness around what's going on in the credit markets.
I think just to emphasise a couple of points that you make. One, this is another example. Two, it's in a bit of trouble. And that's important because it's the build-up of the number of cases that we're starting to see in the private credit space.
Cases or cockroaches?
Or cockroaches. But none of them are particularly significantly dramatic in and of themselves.
Yeah.
So in the most recent case, the Apollo Private Credit Fund, mid-cap financial investment corp, to your point, Anna, OK, they've lowered their quarterly payout, they've written down the portfolio by 3%, they've come in with a share buyback of $100 million US. On the edges, this is problematic. It isn't dramatic just as one example, but you put them all together, and that's where the level of concern is. It's another cockroach in the mix. And then you bring it to the point, which it was a slightly different story here in the UK with the lender here, focused on the real estate sector, and the fact that the banks are exposed, Barclays amongst them, including Jefferies and Santander as well. Where is the due diligence?
Yeah, and you saw Barclays and Santander ADRs falling, so we'll watch those at the open. But yes, it's the parallels, it's the cascade, and you've already had Bain warning that the software default rates are at risk of hitting double digits. We were speaking to Bruce Richards yesterday. He was talking about 15%, the private credit software defaults potentially hitting, and that echoes the report that we heard from UBS, the even worst case scenario.
Yeah.
So all of these cockroaches, as you say, mounting.
And that 15% attaching to the software companies rather than the private credit lenders who obviously lend to lots of different sectors. But it's a point well made. I think it's interesting, Tom, as you were saying, that, these are just, they're little cracks, aren't they? But they are giving us some transparency, which is maybe not what we'd anticipated. At least some of these businesses, BDCs, are listed in the States, so they have to report. And so there is some sense that we get these lines in the sand, these markers where we take stock and we say, OK, what is the state of this business, which in itself is interesting.
And you could make the point that the scrutiny in and of itself is healthy in terms of the market developments. As you said, there is that exposure to software, and that Apollo Private Credit Fund had about an 11 to 12% exposure to software. We have a reminder of what is happening in the AI space in terms of how the axe is falling on jobs. And this is Jack Dorsey. So take your time back to when he founded Twitter, famously now an impressive beard. But more importantly, he is announcing that they are cutting almost half the workforce at Block, which is a payments company, 4,000 jobs. And I'll just quote from Jack Dorsey then. I don't think we're early to this realisation, and I'm going to paraphrase now, that we need to cut jobs because AI is having the impact and taking on those roles. I'll go back to his direct quote. I think most companies are late. Within the next year, I believe the majority of companies will reach the same conclusion and make similar structural changes.
But that's the story he's telling. You could also point to the fact that the stock's been lagging.
Yeah.
It's had rolling job cuts for a while now. They usually tie them to annual performance reviews. Is it just that Dorsey would like to think that this is about how good the AI is, or is it actually because the company's struggling?
And that taps into a big live conversation that we're having in lots of parts of the white-collar economy about how many jobs are going to be taken, how many jobs are just going to be turned into new jobs. All of that still very much the conversation. There are other tech themes, Tom, that we need to pick up on, and we have contrasting fortunes at CoreWeave and at Dell, don't we? One saying it's doing really well, this is Dell, on the back of AI-related servers, and CoreWeave, kind of incredibly, because this is a data centre business, but not doing so well.
No, because they have to spend very heavily to meet the demand. They still see that demand, they say, but obviously to meet that demand, to match that demand, to build out the data centres, to buy the NVIDIA chips that they then lease out to their customers, who include companies like Meta, they have to spend very heavily. They're looking at capex, potentially CoreWeave, of 30 to 35 billion US dollars. That is above the expectations. They're also borrowing a lot more as well. So they're going to the debt markets. They're looking to raise $8.5 billion to help finance that in terms of dollars. And the losses came in larger than expected for CoreWeave. The flip side, in terms of the hardware story, Anna, you mentioned this, is the story around Dell, which has pivoted and seemingly very successfully towards the server piece when it comes to data centres. They came out with stronger than expected earnings, Dell, and they expect to generate $50 billion of AI server revenue in the current fiscal year.
Yes, and actually the Dell share price move, it really jumped after hours, and the CoreWeave share price down by 13% after hours. So we've seen some substantial after-hours moves on the back of those numbers.
It's like we discussed with Karen Ward yesterday. You're seeing companies being rewarded for capex restraint at this point, and we saw it with LSEG yesterday, one of the topics we discussed with the CEO. Which takes me to the UK, because we've got to talk about the by-election, a result that perhaps is going to create more nightmares for Keir Starmer. The Greens winning this special election in Gorton and Denton. It's the first time in more than 90 years that that seat won't be represented by Labour in the House of Commons. It's a seat Labour easily won only 19 months ago, and it opens up Starmer to internal criticism, because you'll remember that the Greater Manchester Mayor Andy Burnham had been a name that was floated to be Labour's candidate there, but instead they went for a different candidate and they've lost. So if you look at the market reaction as well, the pound initially gained, it's been fluctuating since. It seems like initially there was relief that it wasn't victory for reform, Nigel Farage's party. Now perhaps more of a focus on the headache for Keir Starmer.
I wonder if a victory for the Greens makes this look less useful as an indicator as to what happens nationally, because this doesn't reflect the national polling, does it? Reform very much in the lead when it comes to the national polling. It's interesting, I was looking at one of the professors of Rob Ford, one of the politics professor, referring to this as a Frankenstein's monster of a constituency, because it's been stitched together. No, because it's been stitched together from lots of bits of other constituencies. It's a real patchwork, and as a result, quite difficult for pollsters to get a sense of what it was going to... And it contains a lot of students and high Muslim population as well, both of which lent very strongly to the Greens.
What does it tell us in terms of how we price political risk for the UK, though? And that's the question as we lead up to the May elections. And as an investor, do you want to be starting to price in increased political risk? And how do you play that? Do you play that in the pound? Do you play that in gilts? A lot of the guests that we've been speaking to said a lot of risk premium is already priced into gilts. And Goldman Sachs famously putting out a note a few weeks ago saying there's further upside to gilts. So yields down is the projection from the team at Goldman Sachs. And again, we've heard guests who said a lot of the risk premium is already priced in. We'll see if that's reflected in the session today, or if you want to be starting putting positions in ahead of May if the Prime Minister comes under increased pressure. Of course, the Greens could end up being a coalition partner, potentially, in some scenarios, and that could pull the Labour Party further to the left. More spending, I guess, would be one risk factor for some investors. Well,
of course, it comes ahead of the Chancellor's spring statement next week, and we'll have special coverage of that. So do join us on Tuesday for our special show.
Should we break you some lines in terms of the earnings? So we'll switch from politics to the earnings story. IAG, the owner, of course, of Iberia, but also British Airways. Fourth quarter revenue, missing estimates. They see 2026 capex at about 3.6 billion euros. They are announcing, this is important, another €1.5 billion buyback. Fourth quarter, in terms of fourth quarter revenues, that was softer then, coming in just below 8 billion euros. The estimates had been for about 8.1 billion. The load factor, 85.1%. That's slightly above the estimates. But again, it's the buyback that will be in focus for many investors. announcing another €1.5 billion in terms of the buyback. And we're going to be speaking to the head of IAG later in the show.
Just one of the themes of the week, buybacks. We'll certainly get to that conversation. Let's tell you about some of the other conversations we'll be having during today's programme. James Turner, BlackRock co-head of EMEA Fundamental Fixed Income. We'll get the fixed income perspective on what we've been hearing about UK politics. We'll also talk about the US, where that goes. Nina Skero will be with us, CEBR Chief Executive. Certainly a focus as we head into that spring statement. The government's not giving us any sense that this is going to be a major fiscal event. But what do we need to know about the UK eco story? Max Kettner, HSBC Chief Multi-Asset Strategist, will be with us. That's around 8 o'clock UK time. Christophe, Périllat, the Valeo CEO, will be with us during the programme as well.
All right, that's what's on the show. Let's take a look at what else we're watching out for today. At 9 a.m. London time, we've got Norway's Sovereign Wealth Fund releasing its annual report. Then we've got plenty of economic data with the ECB's 1- and 3-year CPI expectations also at 9 a.m. Then 1 p.m. London time, we get the latest German inflation data, expected to have held at 2.1%. Before we turn to the Bank of England at 1 p.m, Hugh Pill, the chief economist, speaking here on the UK and US economy at the Elgin Advisory and Society meeting. And then at 1:30 p.m. London time, it is the main data point of the week stateside. US PPI could suggest perhaps that core PCE deflator will come in hot for January, and that perhaps could dash hopes of rate cuts in the first half of the year, Tom.
Here's what else to think about this morning then. US and Iranian officials ended the latest round of nuclear talks in Geneva with no new deal, but agreed to reconvene as soon as next week. The two nations have been locked in a tense standoff over Iran's atomic activities, with the US massing military forces in the region and Iran refusing to allow its highly enriched uranium to be moved out of the country. Anthropic has rejected the Pentagon's latest offer to defuse a standoff over conditions the company has sought governing the use of its AI software by the military, escalating the standoff between the two parties ahead of a government deadline. The company continues to insist on two specific restrictions. It doesn't want its tech used for surveillance of US citizens or for autonomous lethal strikes without a human in the loop. And Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch its $111 billion deal for the historic Hollywood studio. Netflix said that while it believed its deal would have passed muster with regulators and created shareholder value, it didn't want to keep bidding. And you will notice, Anna and Lizzie, that investors in Netflix, who had never been much of a fan of this bid, have cheered this decision for Netflix to pull the curtain down on this episode.
What a season finale. Netflix is bigger, stronger, healthier. Paramount is richer, and that's the suitor that they've gone with in
the end. Is it richer and also better connected, I think is a question. There was a lot of lobbying, wasn't there, in Washington?
Yes, absolutely. And there's a lot of confidence as a result of that love in Washington that this deal will get done under Paramount. It seems, not least from the Paramount board themselves. They're so confident that they're going to be able to get regulatory approval for this, that they're paying a so-called ticking fee, 25 cents a share, to the shareholders of Warner Brothers for every quarter where this deal does not get done and does not deliver. So they're pretty sure that they have friends in all the right places and that this will come to pass.
Yes, and Netflix stock, since they announced their interest in taking over Warner Brothers, was down about 40%, and then, of course, aftermarket rallied on the back of this news. So we'll continue to watch that stock as well, and the broader impacts.
Yeah, coming up on the programme then, we check back in on the earnings story with British Airways parent company IAG. After their fourth quarter revenue numbers just came in, we'll be speaking to the firm's CEO Luis Gallego at 8:10 UK time. Transatlantic travel, oil prices, all of that very much in the mix. Plus, Bloomberg has learned that Equinix and Canada Pension Plan Investment Board, CPPIB, of course, are said to be nearing a $4 billion deal to acquire AtNorth. That is a pan-Nordic data centre operator. Data centres, very newsworthy. We'll be speaking exclusively to the Equinix managing director for more on the possible transaction, and that coming up later on this morning. Up next, the Debt Management Office has announced the UK is set to slash gilt sales to its lowest in 3 years. We'll be talking all things fixed income with James Turner, BlackRock EMEA head of global fixed income. That conversation coming up shortly. If you have questions, if you want to get involved in any of these conversations around this desk, IB plus BBTV Go. That is the functions used on the Bloomberg terminal. This is Bloomberg.
welcome back. We are a little over 40 minutes from the opening trade this Friday. European futures pointing higher by a modest 0.1%. Still close to record levels, but it seems equity investors looking for the next catalyst.
Yeah, absolutely. And doing so with a smile on their faces, perhaps this morning, Friday the 27th of February. Let's turn our attention to what's happening in fixed income markets. Federal Reserve Bank of Chicago President Austin Goolsbee says interest rates could come down further in 2026 if there is more evidence of falling inflation. Joining us now is James Turner, EMEA Head of Global Fixed Income over at BlackRock. And very good to have you with us this Friday. Thanks for joining us. So, James, that quote from Goolsbee, sort of putting the focus on inflation, if inflation does this, we'll be able to cut rates more. To what extent is that still the dominant theme that you're watching? We have lots of guests come and talk to us and say, actually, we're focused more on the fiscal side of things, or we're focused on the AI software fallout. What's dominating the conversation in US fixed income markets?
I think from the point of view of rates, the inflation is really, I think, most of yesterday's story. I think actually it's been tamed generally. It's still going to come down. I don't think the tariff announcement's going to make too much difference to that. It's still on a controlled path. I think actually the bigger issue is actually employment. Particularly amongst youths and younger area of the population in the US, the unemployment there should be the focus. And I think that's the thing that's really allowing central bankers to say we need to reduce rates a little bit further, and we still expect a couple of rate cuts for the remainder of the year in the US, and still on a downward path from that point of view.
We were speaking to a guest yesterday who said that the reaction function at the Fed will be kind of asymmetric, and this is with and without Walsh, I think they were saying, that the Fed will be very alive to risks around the job market and will cut when they see them. They won't be quite so worried about inflation pickup. Are you in that kind of camp?
Yeah, I think that's exactly our view as well. Really, I think the thing that they have, an aim to improve employment, and one of those things that I think that's mostly the dominant theme that's going to affect the economy. When you look at actually where the inflation's come from, I think it's areas that actually aren't going to be particularly impacted whether you cut or raise rates. And so actually the impact of rates is going to be relatively limited there, but it'll be very helpful in terms of the employment market, and it really needs to be directed towards that. But it also comes to the point that actually, when we're looking at where we prefer to invest at the moment, it's not in duration, it's not in long-end rates, because I think there's still going to be some volatility, there's still going to be some noise around that. And so really, when we're looking at where we prefer to get our yield at the moment, and yields are very attractive still, we'd rather get it from sectors where we're taking a little bit of credit risk, a little bit of spread risk, but certainly more in the short and medium end of the curve and the belly of the curve.
Is there a contagion risk from what's happening in private credit with that focus on software?
I think probably in Europe, no, not so much, because when we look at the exposure to Europe in the public markets, and we look at the investment-grade corporate markets, we look at the high-yield markets, really there's very little exposure to software. It's single-digit, low percentages. I think one of the things that we need to be alive for, though, is that it is a time when spreads are a little bit tighter. There's less room for error when you're looking at credit at the moment. But having said that, it's really a time where there's going to be some winners and losers. There's going to be some clear winners from AI. I mean, you can look at banking sector as an example, you can look at utility sector as an example, all asset classes or sectors that are very well represented in Europe. So there's opportunities there, but there's clearly also going to be some losers. And I think one of that is we're working out which of the software companies are going to be most affected, and which are the ones that are going to continue on as normal.
Are you seeing that differentiation between the US and Europe then affecting flows? What's happening in terms of the flow show into European credit?
In all honesty, we haven't really seen a huge amount of differential in flows. I don't think it's like causing differential at the moment, because even when you look in US public markets, when you look at the software exposures or the AI exposures, it's mostly to the hyperscalers, it's to the larger companies, and actually I don't think people have concerns over those. I think it is more of a private credit and a senior loan exposures that people are worried about. And that could have an impact on those markets, but in the reality, I think it's contained within those markets at the moment.
I want to ask you about UK politics, because we've just had this by-election in Gorton and Denton, the Green Party winning. The pound's already trimmed its gains. As we look ahead to May, who's worse for gilt, with the Greens or Reform?
Well, I think the one thing that we shouldn't be too is this is one by-election in a mid-term part of the political spectrum, and so we shouldn't read too much into one by-election. I think actually the bigger thing is, how is the UK economy doing? Will we see growth from the UK economy? Certainly we've seen some better receipts in terms of, and I think there's some breathing space that the Chancellor has now because of some higher tax receipts. So I think the bigger focus will be on that rather than reading too much into one election result.
Well, we saw unemployment overshoot, inflation dropping. Is March live for the BOE?
It's a possibility. I think we haven't got a strong conviction either way, but I think certainly it doesn't change the trajectory of rates, that rates will continue to come down in the UK.
So if we're thinking about the gilt market and how it responds to the politics, yes, absolutely, it's one by-election, and the voting pattern perhaps doesn't reflect what's happening nationally anyway. Does that mean we would look for a sort of muted response in gilt markets today? Are they able to focus on the real economy? We also had some GfK numbers out this morning showing some weakness in consumer confidence. I mean, where is the gilt market going to focus in the short term?
I think actually it'll look through this result. I don't think it will be a huge impact today. I think what we need to really do is, and we must remember that when we've looked at 25 and if we've learned something from 25, what we really need to do is look at the longer term view. We don't need to be swung around or whipsawed by noise in the markets. We need to look at the longer term view and think actually, and particularly when we look at Europe as a whole, the economy is still doing pretty well. We've got stimulus coming in from Germany. We've got inflation under control. We've got a very good central bank path in terms of rates remaining stable. And so a very, very positive environment in total for fixed income.
Yeah, can fixed income investors do that? Because it seems it doesn't take much for the politics in the UK or the politics in France to suddenly become the epicentre of everything. And you know, you see fixed income markets moving around on every little bit of political news flow. Can they step back and reflect on and focus on those bigger picture?
I think it's beholden on us to do that, and I think it's beholden on the best of investors to do that, actually, to look through and just remember that actually you want to sort from the noise the actual ultimate story of generating income, which is what people want at the moment, what's available. And certainly what's available when you look at the fundamentals of things like corporate credit is extremely attractive. EMD is also an attractive area, high yield still attractive. Generating that income that I think is available for the first time in many decades that people want from the yields you can get.
And the narrative around Europe is still constructive when it comes to credit, private credit, when it comes to a fixed income, I should say, and corporate credit.
Yes, I mean, very much so. If you look at the way companies have managed their balance sheets, generally there's an improvement in balance sheets. I think you have to be careful because I think there's going to be bigger dispersion than ever, and you can already see it in the market. If you look at the average spread, there's not much you can buy around the average spread. There's a lot you can buy either way of it, but that means it's a time really where there's dispersion, but also you need to make sure you get your credit selection right because there is much less room for error when you've got these spreads as they are. But having said that, if you get it right, you're going to compound that high levels of income you're getting from the yield. It's going to be a very good environment for fixed income investors still.
James, thank you very much. Thank you for joining us. James Turner, EMEA Head of Global Fixed Income at BlackRock. We have plenty of time to focus on UK themes, don't we, with our special coverage coming up next week.
I'm going to be in the cold, cast out while you two are in the studio.
I was over in Sweden where it's -6, but wasn't it 17 degrees on Tuesday?
It was a lovely
could get
day.
a balmy, sunny day.
Okay, nobody tell anyone I haven't done a stint in the cold for a very long time. Long may that remain. Coming up on the programme, the Green Party wins a special election for a Manchester seat in the House of Commons. Where does that leave Prime Minister Keir Starmer? We've talked a bit about the gilt markets and the pound and how that's responded. We'll get that big picture macro take on the UK economy. Nina Scarrow joins us next. This is Bloomberg.
30 minutes from the start of the opening trade, the futures picture looks pretty tepid here in Europe this morning. The Stoxx 50 only up 0.1%. The FTSE set to outperform, and the CAC 40 also looking rosy, but really not a whole lot of movement this Friday morning.
But if we get any, could be to the upside. Let's have a look at where we are on bond markets. Of course, we'll be focused on gilt markets. Our last guest telling us he thought that gilts will look through the political news coming through from one particular constituency here in the UK, in Manchester, but we'll see. That we will have to wait for half an hour until we get the open of those gilt markets. So we'll look for that. In the meantime, the rest of the European bond market story looks fairly unmoved, Lizzie.
Yeah, and in the meantime, the pound paring the gains that it had seen following some investor relief that the Reform Party did not win the Gorton and Denton by-election. Instead, the Green Party won the special election for this Manchester seat in the House of Commons, underscoring the threat posed to UK Prime Minister Keir Starmer's governing Labour Party on its left flank. Well, joining us now to discuss is Nina Skerro, Chief Executive of the Centre for Economics and Business Research. Morning, Nina. Nice to see you. So this is the first time that Gorton's not going to be represented by Labour in more than 90 years in the House of Commons. Is the Greens' victory going to pull Labour to the left and encourage more fiscal loosening?
Well, that is the big question, sort of, as I try to process what this might mean in the longer term for our UK outlook. On one hand, you might say, it's one by-election, let's not read too much into it. But the problem is that this is a second major problematic situation for the Prime Minister in almost as many weeks. He's only just come out quite bruised of the Mendelssohn situation. And now you have this really, really disappointing performance for the party. So it does seem very likely that following some more elections we have coming in the UK in May, that his position is very uncertain, and you could very much lead into it that the fact that they lost to the Greens, not to Reform, that the question is going to become, hold on, we've kind of been trying to be centrist to fend off that threat from the right. Should we actually be more extreme on the left to fend off the threat from parties with more similar ideologies to our own?
Exactly, but what about that threat from the right? Is Reform looking more market-friendly? Because it certainly seems like it's trying to. They've got all of these Conservatives joining their ranks. They're trying to look like they have that experience in the party, even if they're having to import it. And, I was speaking to Richard Tice on Bloomberg TV. He was pushing the idea that they'll balance the books and they won't bring about a Liz Truss moment. Do you buy that?
Well, the party is definitely seeming to professionalize, to build as an organization that's preparing to be a major party in the UK. I think they are a little bit harder to predict because they are newer. They are less well organized than somebody like the Conservatives, who really runs sort of I think the comparison would be, one is like a large corporate with established comms channels, established practices. Businesses know how to network, how to lobby. Reforms is a little bit more sort of like the scrappy startup, and it's a little bit harder to predict their next move. But for those people that have been saying, yeah, they're polling really well, but is that real support? Is that just dissatisfaction with how the UK is going more generally? This is going to pour cold water on that argument. They do seem like a genuine political force.
And Nina, the irony is that in terms of the fiscal headroom that the Chancellor has, that has increased. In terms of the tax receipts, those have increased. So at least on those metrics, things are looking a little brighter for a UK Chancellor that you are suggesting could be out of office potentially later this year. At least the pressure, you've said, will be on the leadership. How vulnerable is this UK economy to any change at the top post-May?
I don't think the UK economy or the fiscal picture are facing an immediate existential threat. I think that's what a lot of people mean when they say things have actually stabilized. We have the spring statement coming up next week, things to be sort of steady. But growth has been extremely low. So I think what people are describing as a pretty good situation is really kind of the absence of a disaster. So I would say things have stabilized, but sort of, looking at a 2, 3, 4 year horizon, growth needs to come from somewhere if tax receipts are going to continue coming in.
How worried are you about graduate unemployment?
Well, pretty worried, because that's kind of one problem that the UK hasn't had in a little while. The labour market has remained very resilient until now. And there are big questions on a global level about what young people going into employment, how that's impacted by AI. Some people, some industries are saying we're going to hire less because we're very hopeful that we can replace some of that junior level work. So I think there's that story, which is not a UK story. That's just a global story. But in the UK, the picture seems to be softening as well.
Just on AI, are you seeing a lack of productivity gains that had been promised, but an impact on the workforce?
I think there are a lot of businesses that are kind of making their plans for hiring now based on a benefit that they expect in the future. So businesses in the UK have been under a lot of pressure from taxation, from employer NICs, from the higher national living wage. And a lot of them are taking a leap. I would say, well, are we actually going to need the people that we would hire now in 2, 3 years' time? Let's take a more cautious approach. Let's not overhire. Let's actually maybe underhire, and kind of putting a lot of hope in that.
And Nina, you listed there some of the reasons why people point to the politics and say there was a political effect, or the decisions that the Labour Party made around NICs, for example, is having an impact on the labour market, and some economists do make that link. On the other side, you could say, well, with minimum wage going higher, surely that could be positive for growth if that money goes out into the economy and is spent. Did that never happen? That was the hope that the Labour Party had at the time.
I'm firmly in the former camp. The minimum wage is just too high. If you look at it where it stands relative to the average wage, it's just too high. I'm not saying it should be zero, but it's just gotten completely away from a reasonable level where it's protecting workers, and I think it's firmly long-term dampening employment prospects and leading employers to decisions like we're maybe seeing now coming online, where they're actually very, very hesitant to hire.
Okay, and so then as we look ahead to the spring statement, I mean, probably no change on that particular front. We're being led to believe that there's not going to be any change on anything, really.
She's calling it a spring forecast, apparently, internally at the Treasury.
Yes, giving it a new name, rebranding it to kind of downplay our expectations. So we don't expect any tax changes then, we don't expect any spending changes particularly, although there's been a lot of heat and noise created around student debt. Is that going to be an area? What should we look for next week when we get this spring, whatever it is?
I wouldn't actually expect any surprises. I think if she was actually preparing anything, we would have probably heard whispers of it in the press already. I think even though it might feel like a long time for a lot of policymakers, the mini budget actually feels very recent, and I think there's a lot of hesitance to surprise. So I genuinely think that if we were going to get anything on any policy area, we would have kind of softly seen it reported already. So I really think that she's going to report on the OBR forecast, which will still be interesting, even though the OBR is not making a formal judgment. It's not going to take a lot for the rest of us to look at what they're publishing and kind of say what their judgment would have been if they were formally making one. So there's still going to be some publications of interest, but I am really expecting her to stand up, share the forecast, say that some recent receipts have been good, that the OBR is confident, and leave it there and see if she has another budget to come back to later in the year.
And that's it.
You say the Liz Truss moment's still fresh in the memory. I wonder how much space there is for Rachel Reeves to break the fiscal rules. It kind of comes back to my original question about whether Labour could be pulled to the left by the Greens, but also with the Conservatives in mind. I was speaking to an economist who's been talking to them, and this economist was floating the idea that the Conservatives could get away with tax cuts if it was part of a real growth plan, right? One that the market believed. Would the bond vigilantes forgive that?
I think it would also depend on what the OBR's judgment would be on whatever policy was being put forward. OBR in more recent years has shown a greater level of comfort when making judgment calls on how much economic growth is going to be supported by a fiscal policy. So, for example, we saw this when additional paid-for childcare hours were introduced, and there was a strong suggestion and a comfort with that was going to really support labor market activity and therefore lead to growth, and that therefore that was kind of a good type of spending. So I think there would be an element of judgment there, but I do think there probably are some policies where they would see tax cuts or additional spending in areas, and that the market would accept that, especially given that things have been steady for a little while.
Nina, where does this all leave the BOE? Do they cut in March? And if so, do they follow that up with another cut by the end of this year? What expectations do you have for the Bank of England in terms of their response?
Our expectations are yes and yes in March and then in June. We were actually already expecting that before their last set of minutes. And then after that, we were really expecting that. There was in some of the interviews and some of the commentaries a little bit of an acknowledgement that there was some political unrest possibly coming. That actually then died down. Of course, we mentioned the by-election political sort of upheaval might be now coming. But at the moment, we are expecting 2 more cuts this year, and we're pretty comfortable with that view.
Nina, thank you very much indeed, as ever. Nina Scarrow, Chief Executive of the Centre for Economics and Business Research. Next week, we will have special coverage of that UK Chancellor spring statement, or forecast, potentially is how they're going to rebrand it. Join us on Tuesday for that. And returning to credit, where concerns are mounting, California pension fund giant CalPERS stands firm in its private equity conviction.
We had an 8% allocation to private credit, and I think we're hovering around 4%. And we believe that book is diversified enough that, the team is really not too concerned about the software exposure.
We'll bring you more on those credit jitters next. This is Bloomberg.
Just over 16 minutes away from the opening trade. Here's what the European futures picture's looking like. Not much doing, really. Euro Stoxx 50 futures up 0.2%. A brighter picture for Paris and London this morning. But if we flip the board over and we can take a look at how we're faring towards the Wall Street Open, futures there are to the downside. We have had those tech results, CoreWeave shares falling in late trading. By contrast, Dell shares jumping. But beating both the US and Europe in February on this last trading day of the month as we look back across February. Asia, Tom.
We're showing you the Asian benchmark, which on an intraday basis is not particularly exciting. But it is worth noting that it is set, nonetheless, for its best February on record, the MSCI Asia Pacific. The Kospi, which is down 1% in the session today, not reflecting really what's been going on. It's up 20%, Anna, in the month of February. This is the last trading day, of course, of the month. The Kospi is up about 50% year to date because that shift and that pivot towards the hardware themes and the tech themes and the chip themes of Asia has lifted the benchmark broadly. Again, record, potentially record February.
Record. And for the record goes back to 1998. So, yeah, it's a decent amount of time. So that's what we have in terms of the Asian equity session. Let's get to some breaking news coming through from France. The French CPI numbers just breaking. The harmonised CPI rising 1.1% year on year. The estimate was 0.8% to the upside. Now, that could set some cats amongst pigeons because the story, Lizzie, around inflation in the Eurozone has been that there isn't an inflation problem and that the ECB's on hold for a long time.
And it's in a good place.
And it's in a good place. And maybe that doesn't change, it's just one bit of data from one part of the Eurozone, but certainly the euro is responding, as we see there, up by 0.2% so far. A little bit of a spike up, Tom, in the euro this morning.
Yeah, 180, bit of a move higher on that, slightly stickier than expected French inflation. Let's get to what's happening on the deals front. And this, of course, is the one that's had us on the edge of our seats. It is the Netflix deal, dropping out of the battle to buy Warner Brothers, clearing the way then for Paramount to clinch that deal. Shares in the streaming giant soaring in after-hours trade, while Warner slid. Let's bring in Manuel Baigorri, Bloomberg's deals reporter. Manuel, you've been following this very closely. Netflix open with this deal. Why has it decided then to bring the curtain down on its bid for Warner Brothers?
Yes, Tom, and as you well said, this deal has kept us on the edge for quite some time, isn't it? Fascinating story to cover and to follow in a really amazing saga here. I mean, Netflix just came to the conclusion that it was better for them to walk away and let Paramount negotiate the deal with Warner Brothers and see whether or not they can get regulatory approvals. Paramount came back with a knockout offer, $31 a share, plus a few addendums to sweeten the deal. In the potential transaction, Warner Brothers and the company Warner Brothers had to consider that seriously and came to the conclusion that it was a superior bid for the shareholders and for the company as a whole. So now remains to be seen what the next steps will be. But for Netflix, definitely, it's been a bidding war, tremendous bidding war after the agreed deal they had on the table with Warner Brothers in December. And obviously, they came to the conclusion that increasing the offer further could jeopardize perhaps its own financials. So they decided to drop out.
What does this mean for Warner Brothers' news divisions then, Manuel? Because actually, in the end, a lot of the competition between the two sides came down to the value that you put on not the new, sparkly, shiny streaming assets, but some of the older, more traditional media.
Yes, that's a very good point, Anna. Remains to be seen the different assets within the group and how that it's going to potentially play out on the transaction. I think one step at a time now, the companies need to get regulatory clearance. That's going to take several months, if no quarters or even more, potentially depending on how smooth the approvals go, especially on the antitrust side of things. We may expect a lot of politicians, regulators weighing in and industry leaders as well. But for the news side, definitely, obviously, an influential side of brands there. And I'm sure everybody will have their own views as in how and when those assets may come to play and how it could also be integrated in the new combined entity.
OK, Manuel, thank you very much. Thanks for joining us. Our deals reporter, Manuel Baigorri. Joining us now, broadening our lens, Markets Live Executive Editor Mark Cudmore with 3 minutes on the markets. And Mark, we have not mentioned, perhaps as much as we should have done so far this hour, oil prices up by 0.7% right now on Brent, 71.22 as I speak to you. Every weekend, it seems, over the last month or so, we go into the weekend a little tense, a little nervous about what might happen in the Middle East. What's your thinking around oil and the Middle East outlook?
Yeah, absolutely, Anna. That is the setup that every weekend we've got to be prepared now. It feels like for the last year we've had to be prepared for every weekend. If it wasn't Iran, it might be some other Trump action out there. That said, it seems like the expectation in the market for any serious escalation this weekend is very low. That means, obviously, if there is something that happens, it will have an outsized reaction in kind of when markets open on Monday. So we're all on alert, but not expecting anything. That's what we're kind of prepared for the weekend. I think at the moment there's a lot of turmoil going on underneath the hood in markets, which we've talked about a lot, mainly driven by the kind of evolving AI trade. But from a macro lens, markets have been incredibly stable recently. I'm finding it very uninspiring this Friday. You've got rates markets have been in a tight range for a long while. FX markets going nowhere again. Compared to the start of last year, where we had really, really exciting macro markets again in terms of the FX and rate sides, with the big dollar downtrend. It looked like the start of the year we're going to get another leg in that. We did get one more leg, but we've kind of paused again. So I think we're waiting for the next big macro trigger. And I think everyone's wondering whether that coincides with a more extended equities sell-off or whether it's the next major leg higher in US stocks.
Mark, we've been reflecting that it's been a record February for Asian stocks, but the Kospi selling off. Is that all there is, at least for Korea?
I mean, I think the Kospi was down 1% today, which relative to whatever it was, 300% in the last year or something, and 50% so far year to date is kind of irrelevant. That's the kind of move it makes in a few seconds at the moment nowadays. We did actually think that the Bloomberg terminal might be broken when we saw it was negative prices on Kospi. It is such a rare event. It's just, you don't normally see that anymore. But no, look, I think everyone knows why the Kospi trade's doing well. The index, it's got to be important, is really dominated by two stocks, SK Hynix and Samsung. They're great companies that are everyone expects to benefit from the AI boom. I'm in that camp as well. The stock market's not overly expensive. These stocks aren't overly expensive. It is a sustainable trade, but might have got a little bit too carried away in the short term. So, just over 50% already in the first 2 months of the year is just too much, too quickly. Even if longer term, it's probably quite a good region.
Mark, what's the result going to be? Ireland, Wales.
We've got another week. I'm so upset. This weekend would be much easier if I had the rugby to look forward to. Part of the reason I'm so disappointed this Friday is there's no Six Nation. But of course Ireland are going to win. It's not that this Ireland team are as good as they should be, despite the record victory against England at Twickenham last week. But, fortunately, Wales are really quite useless at the moment, with apologies to all Welsh people out there. They really are terrible at rugby.
I don't think we heard. Did we hear that? Record victory against Twickenham, against England at Twickenham? Yeah, we'll look past that, of course, that brutal result, and well earned, of course, by Ireland. Mark, thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get your stocks to watch now with Charlie Wells. Charlie.
Good morning, Tom. So it's really earnings and banks that I've got my eye on this morning. And I want to start with Delivery Hero, because we've been talking a lot this week about delivery companies, not just in Europe, but also in the United States. You can see here year to date the performance of Delivery Hero. That is in the orange there, down significantly since the start of the year, along with Uber, along with DoorDash. Let's see what happens, because Delivery Hero delivered an earnings report that missed expectations. And they've been under a lot of pressure, right? They've been under a lot of pressure because of these two here, a lot of competition across the globe. They've been under pressure from investors to divest, to exit some of their markets. But there has also been this issue of that AI scare trade. We heard a lot about this issue of potential white-collar layoffs and what that could mean to these services that we know a lot of white-collar workers do use. There's been pushback on that, but let's watch how the market reacts this morning. We have to talk about banks, because we've been talking a lot about market financial solutions, that non-bank lender that collapsed into a form of insolvency on Wednesday. And what we were hearing about was exposure, that some of these European banks, Santander, Barclays had to Market Financial Solutions, providing some financing to them to the tune of hundreds of millions of pounds, according to a judge. So we're going to watch that. Banks have been performing well this year. They've been performing well over the past few days. But Jefferies, which was also kind of tied up in some of the exposure to MFS, that was down yesterday. So let's see how that happens. Montepaschi as well. They have a statement saying that they're going to be returning 100% of net income to investors over the next 5 or so years. That is a show of force for a bank that is integrating Mediobanca as well.
Charlie, thank you. Charlie Wells. A quick moment to reflect on that inflation print we had out of France, because it was stronger than expected, and it has had some market impact. The euro pushed up by 0.2%, so it is up against the US dollar as a result, as we just, lightly put inflation in the Eurozone back on the agenda. Bond markets did see some response. We saw yields go higher, but that was kind of short-lived, now pretty flat again.
Yeah, it seems unlikely to change the calculus for the ECB, but it's a reminder that maybe in some areas there's a little bit move higher.
And some are worried about disinflation in the Eurozone. So
is that still to come? We'll see, Coming up on the programme then, we will bring you the start of European trading day. Futures have been pointing a little stronger this Friday morning. We'll be back with the market open. This is Bloomberg. Welcome back, everybody. A few minutes to go until the start of cash equities trading here in Europe. This is the session from the United States yesterday, and some of this volatility during the US session in the early part of their trading day, we captured in our European session. So we're sort of through that. Some of that was driven by Iran and by oil prices. Some of that news flow. We've got another meeting taking place in another week on the subject of Iran. So does that mean we put that to one side for the weekend? We'll see. Mark Cudmore telling us that that is still the big risk that markets are very much alert to as we head further into Friday and into the weekend. So that was volatile yesterday in the US morning session. The afternoon looked relatively a little calmer, perhaps, but a little bit of upside maybe coming through by the close. And so, Tom, the European futures picture looks a little positive.
It looks like it needs another catalyst, doesn't it, in terms of the European equities picture. But the story remains that European stocks have outperformed US stocks year to date. Asia, of course, has outperformed Europe. But the upside is, it seems, there for European stocks, grinding higher, pointing higher by about 0.1%. Here in the UK, the FTSE 100 may be reflecting on some of the political risk that's coming through, but pointing to upside nonetheless, up 15 points so far in terms of build-up to the open. DAX futures looking to add 24 points, pointing higher by about 0.1%. Lizzie, what are you looking at?
Well, I'm focused on the earnings that we've had out this morning. I'll start in Anna's favourite sector, cement. Holcim results out this morning saying that they expect profit to increase this year. They're seeing growing pressure on the building sector globally to decarbonise, but that boosting demand for their sustainable products. Also looking at BASF out of Germany, expecting roughly flat earnings this year, and Swiss Re in insurance out of Switzerland announcing a share buyback and increased full-year profit. So just a few more stocks to keep on our radar this morning, Anna, as we inch towards the market open.
Yes, edging towards the market open. I take it entirely as a compliment that everybody thinks I'm obsessed with the real economy and keeping my feet firmly on the ground. Let us have a look how these European equity markets open up then this Friday morning. The FTSE 100 out of the gates with a little bit of upside. Maybe that is all we get this morning, up by 0.1%. The STOXX 600 as a whole then pretty flat. We don't have a huge amount of important data points coming through. We haven't had this week. Next week starts to look a little busier. Certainly the non-farm payrolls looms on Friday, and we're starting to see options pricing around that. So the market is starting to think ahead to that macro theme a little later on. We're also gearing up for a weekend where we'll watch the news flow with regard to Iran very closely, of course. The CAC 40 then down by 0.1%, the IBEX down by 0.25%. Tom, do you see anything exciting in the sector's picture?
Top of the list in terms of your sectors, basic resources up 2%. You're seeing gold prices higher, copper is higher by 1%, a little over 1% so far in the session. So that's feeding into the basic resources. Modest optimism is coming through. Top of your list in terms of sectors. Tech, interestingly, is up 0.2%. On the downside, utilities, typically, of course, a safe haven, currently the biggest loser on a sector-by-sector basis, down 0.7%, followed by media, travel and leisure down 0.5%. That is the sector breakdown. Most sectors in negative territory so far, but of course we continue to see the pricing reflect. Lizzie.
Well, I'm just focusing on those earnings stories that I had highlighted earlier. A few of them still waiting to open, but IAG shares down 0.4%. Rightmove up nearly 5%. I spend a lot of time on that website, waste a lot of my time, but Rightmove there, despite all of the AI worries that we've been talking about, a nice performance there this morning from Rightmove. I've also got an eye on the gambling stocks, because you had that flutter, tepid US forecast. So I've got an eye on Entain. Those shares down 2.8% at the open.
Yeah, absolutely. And flutter yet to open. So we'll keep an eye on that one. And that was a sector that was doing really well yesterday. So we'll see what's happening there. Let's talk about the broader markets then and asset allocation right now. HSBC strategists have cut their US equity overweight in half, rotating some of that allocation into emerging markets and to Europe amid strong economic momentum. The team, led by Max Kettner, remains firmly risk-on, citing an increase in key cyclical indicators such as spending and manufacturing in the last 2 months. Max joins us now, Chief Multi-Asset Strategist at HSBC. I hope that was all correct, what I said there.
That was very correct.
Okay,
I
good.
looked at it and was like, wow, did I write that?
It always makes me slightly nervous talking about a person when the person is sitting next to me. So that's good. I'm glad that was all correct. So tell us a little about what is animating you about Europe and making you dial back exposure in the States.
Well, it's 8 a.m. There's very little that animates me at 8 a.m., to be honest. You know, when you guys were saying, does Tom see anything interesting, I thought you'd introduce me, and I was like, wow, that's already sad if I'm the interesting thing. But luckily, that's not the case. No, what's animating us on that is... I think we're talking probably a little bit too much about AI, right? The story of, obviously, this week was this Citrini Substack. And we're talking about, is AI disinflationary? Is it inflationary? What's the future in 5 years or 5 to 10 years going to look like under AI? You know, what's the next trades? You just said, right, we had a sector yesterday that was up, now it's down the most. So we have this really weird environment where it just day by day is a new trend. And every morning you wake up and it's like, right, what's going to be the topic du jour today? And I think we're probably missing that under the hood, there is some proper cyclical recovery going on, right? You look at PMIs, just simple PMIs, or you look at new orders over inventories, you look at the most open, the most manufacturing-driven economies, look at Sweden, Taiwan, Korea, you know, the likes of even the Netherlands, Czech, right? The really open, the smaller, the manufacturing-driven economies. All of them actually have been starting to see a real pickup in the last 2 months. And that's, I think, what's a little underappreciated, particularly by US rates now. I think we're pricing a little bit too much of this. Yeah. Oh, my God, AI is going to be disinflationary already now. And we're going to see, we'll have to see even more rate cuts now immediately because of AI disinflation. And we're ignoring that under the hood, there is a sort of proper textbook-style cyclical recovery.
OK, so that's all positive. But how much of that is that you mentioned some European countries, you also mentioned some in Asia, and we've got the MSCI Asia-Pacific, I think, having its best February ever, or since the records began, 1998, many years ago. So that's all really good for Asia. Is it as good for Europe? Can it be as good for Europe, or is Asia going to lead on
I think it is. I think for Europe, you know, it depends on what sectors you're looking at, right? Is that really the sort of all go really into the all clear for the autos, for the chemicals? I'm not sure. But if you look at the likes of the banks, right, SX7E, I mean, you're really just along the level of the yield curve. So even if the yield curve just stays where it is, if it doesn't steepen much further, even if it does that, and it just stays as steep as it is, you know, that's really good for the mostly retail and corporate-driven banks. If you look at industrials, look at SXNP, you know, you've got your cap goods in there, so if manufacturing does pick up, you're long that theme. You've got your infrastructure names in there, so if we do see a positive surprise from, let's say, German infrastructure stimulus, maybe some of the order books going up, you're long that. You've got the defense names in there, right, so you've got some sort of geopolitical hedge in there. So frankly, there's, like, you look at the industrials in particular and the industrial goods and services in Europe, you're long a couple of themes with just being long one sector. That's really positive.
Max, banks, industrials, infrastructure, defence, they're quite consensus. Does that worry you?
No, because I think when we look at the earnings side of things, right, and the earnings upgrades of things, side of things, I think that is still going so strong, and particularly I think on the industrial side, where I would be worried is if I say, right, I'm just going to go long defence. I'm just playing this, right? Because I know that, you know, something in geopolitics will flare up, and therefore, you know, I want to be only long that theme. That's, I think, where I'd be a bit more cautious, right? But the good thing, again, right, with industrials, you're not just long defence, you're long the cap goods, you're long the, you know, the infrastructure theme as well. So you're long the miners as well, right? The metals and mining is in there as well. So if we do see some supply-driven uptick in metals prices as well, you're long that as well. So to me, I don't think it is it's an issue to be a consensus there, because you're long so many themes in just one sector that actually, yeah, if one of them, let's say if defense doesn't work anymore for a couple of weeks, something else might pick up. The miners might be picking up because metals prices go up.
Just help me understand the thesis around the US then and cutting that exposure, because we had the Fed expected to cut another 2 times. That's the market price. And you've got the fiscal stimulus, the tax cuts coming through. You've got the lead up to the midterm elections. You've got David Sachs, who's the AI czar to President Trump, saying you could see 4, 5, 6% growth in 2026. What happened to that?
So we were 50% equities overweight in the US and 50 outside of the US. And now it's sort of 25, 75. Right? It's not like we're, oh, God, I'm so bearish US now. It's just that where do I, if I see under the hood that cyclical uptick in growth now happening, where do I want to play that best? Is that really played best in the US, in industrials, or is it played best maybe in Europe? Again, when you look at the industrials and you long multiple themes, you know, you go into emerging markets, you go into maybe something like Brazil, like LATAM, right, where you long the materials, the energy, the financials, if you look at Brazil, right, where it's a much cleaner cyclical, much cleaner value exposure compared to if I just go long the US now. And the issue, I guess, in the US as well is that the cyclicals have rallied already quite a bit, right? Whereas there, it's probably tougher to get the same kind of exposure. I do think when you look at in the US, you look at what we call the lower end of the K-shaped sectors. Think your transport, your US retail, XRT, your home builders, XHB, right? Like all those, I think really you want to go long the cyclicals in the US, but really the ones that are most likely going to benefit from now the pass-through of that OBBB stimulus in the next couple of months.
OK, Max, I'm going to ask you my questions in just a minute. Hold that thought. Max Kettner, Chief Multi-Asset Strategist at HSBC, will be back with us shortly. But coming up on the programme, British Airways owner IAG reporting fourth quarter revenue that missed estimates. And we're going to hear from the CEO, Luis Gallego. That interview next. This is Bloomberg.
Welcome back. This is the opening trade. 11 minutes past 8, 11 minutes into our trading session. Pretty flat at the overall market level for European stocks this morning, up by 0.1% on the Stoxx 600. Basic resources doing pretty well, and we have some movement higher in some of the commodity prices, the likes of silver, for example, and that seems to be helping that sector. Real estate also a gainer to the downside. Media, travel and leisure also weaker. A lot of that has to do with the leisure side, though, the gaming side, where we see a bit of weakness. But aviation also in focus, Lizzie.
Yes, turning back to earnings this morning, British Airways owner IAG reporting revenue for the fourth quarter that missed the average analyst estimate and announced another €1.5 billion share buyback. Joining us now is the CEO of International Airlines Group, Luis Gallego. Luis, thank you so much for making time for us this morning. So you've got a chunky buyback here, but also you're looking at a rebound in transatlantic travel. Just talk us about how the geopolitical tensions and the tariff uncertainty might affect that rebound in travel.
Good morning. So thank you for having me today here. I think that we have seen since the third quarter of last year a rebound in the North Atlantic demand. We have seen, in particular in the case of VA, a strong premium leisure demand that we didn't have before, and also the non-premium leisure is working well. So U.S. point of sale is recovering. Business traffic is also strong, both point of sale UK and point of sale US. So we are positive about the demand this year in North Atlantic.
What risk do you see going forward then? What's your big message to shareholders this quarter?
No, I think the message is that we had very strong results in 2025. We are delivering what we promised. We did it even before that we said to the market previously. The demand that we see for this year continues strong. As I said, business traffic continues coming back. Latin America is also another market that is performing very well. So positive outlook. The first half is on of the year is on plan. So we are positive.
Luis, good morning. Are you still seeing more demand then for the front end of the plane, the business class flights, versus the back end, the economy seats? And does that continue in 2026? How is that picture shaping up?
No, yes. As I said, business traffic is coming back. That's important for us. The profile of the bookings is different because usually business traffic they book late. But the non-premium cabin are performing better than they were performing in the third quarter of last year, and we continue with a strong premium leisure demand. So in general, we have a positive view for the year.
And specifically, you talked about that important transatlantic route, specifically for BA. Can you give us a bit more granularity in terms of how you think that demand picture evolves through 2026? You're seeing an uptick. How confident are you that you continue to see demand there, and kind of what metrics are you and the team looking at?
No, when we see what we have booked for the first quarter, we have a lot of certainty of what is happening. Second quarter and third quarter, the visibility that we have is only 30% book. So, but with that information that we have today, what we see is that, as I said before, we are on plan. Business traffic is coming, and we continue with a strong premium leisure demand. So I think we are in good shape.
Just one more question on the transatlantic, Luis, and then I promise we will move on to other topics. But I'm intrigued because you talked about lots of different bits doing well. What about the UK end of the transatlantic routes, or maybe even the wider European willingness or desire in the leisure cabin to go to the United States? Did that dip, and is it still reduced, or has it bounced back?
No, I think the UK, for example, business point of sale in UK is working very well. We see that for the summer, London market is reducing a little, but we are offsetting that with a lot of transfer traffic to other regions in Europe, in particular to the south.
Luis, I was speaking to your CFO, Nicholas Cadbury, last year, and we were talking about the TAP deal. He said that you would only want a majority ownership situation. How are negotiations going? Are you getting what you want?
Sorry, you asked about TAP?
Yes.
Yes, sorry. No, yes, in the TAP, as you know, we are in the process, but we have a model in the group that we want to manage the assets that we have, the different airlines that we have, and that's something we are talking with the government to see if there is an opportunity to do that. So we need to take a decision if we go ahead or not. We have until April to present a non-binding offer, and that's what we are considering now.
Can I ask you about oil prices, Luis? I mean, a lot of focus on geopolitics, of course, and none of us have complete visibility as to what happens there. With that in mind, how are you hedging oil at this point?
Yes, we have a policy that we changed after COVID, that we hedge the next 2 years. For sure, we hedge more the next 2 quarters. But we follow that policy. We are in a very volatile environment, but we are confident that with this hedging policy, we can have certainty about what we are going to have this year.
OK, Luis Gallego, CEO of International Airlines Group. Thank you very much indeed for your time on the back of those results. Talking of corporate news, we have a redhead crossing the terminal right now. This is in the deal space around data centres. And this is Canada's Pension Plan Investment Board, the Canada Pension Plan Investment Board, teaming up with Equinix, the data centre provider, to acquire AtNorth Holdings. That's a pan-Nordic data centre operator owned by Partners Group Holding, based over in Iceland. They have data centres in Iceland, Denmark, Sweden, the Nordics, basically, Finland as well. So that is a, $4 billion deal. We're going to be speaking to Regina Dahlström, the managing director at Equinix, for an exclusive conversation about that deal. That's at 8:45 a.m. London time. A lot of questions on the data centre space, particularly, of course, that demand coming through from AI and hyperscalers.
Let's check in on the Core 6 this morning, how they're holding up as we start this Friday morning. We have, of course, the likes of Rheinmetall and Novo Nordisk, LVMH, ASML here. A mixed bag, really. The underperformer seems to be LVMH this Friday morning. But let's dive into the individual stocks on the move with Charlie Wells.
Good morning, Lizzie. So it's a Friday, and I know people are going to start thinking about real estate. I do on the weekend because I start thinking about where I want to live. Let's talk about Rightmove. They are up 4.3%. They had a really solid earnings report. They've got a return to shareholders as well. Also in the backdrop of a property market that is looking like it's turning a corner here in the UK. That's on the residential side. Let's take a look at Merlin, which is on the commercial side, and they are doing fairly well as well. They also had a pretty solid report, up over 4% in that commercial real estate space. Now, there's been a really interesting, different story moving out of real estate and into online sports betting. This has been a space where there's been a lot of excitement, but there's also been a lot of competition. You can take a look at Flutter Entertainment. So they are dual listed here in London, but also in New York. They put out a tepid forecast yesterday for the United States, down over 10% this morning. So a lot of pressure there as the markets start to open and start to digest that forecast. Let's take a look at another stock that is down this morning. That is Teleperformance. That is the French outsourcing company. They provide a lot of that kind of customer support that you get, down about 8% this morning. If you think about customer support, you start to think about AI, don't you? Because that is a technology that's really starting to compete here. They were talking about some leadership changes. So again, under pressure this morning. And let's end with a German chemicals company, BASF. That has also been a space that's been under a lot of pressure. The continent really is, the world is really awash in chemicals, as they say, down about 2%. They said they're going to have a pretty soft year, pretty tepid, as they face a lot of competition and that supply of chemicals in the industry.
Charlie Wells, thank you very much indeed on some of the stocks, the individual names on the move this Friday. Let's bring back in Max Kettner, Chief Multi-Asset Strategist at HSBC, who has been very well behaved and sitting, which is unusual for Max Kettner.
You sound surprised.
I am surprised, sitting patiently.
This is about the longest 10 minutes I've ever sat on a chair.
No, well done. Yes, you remind me of some of the toddler kids that hang out with my own children. Max, thank you for your time.
Thank you very
much. Let's get back to the markets. Look, there is a bit of angst. We're seeing that in terms of the private credit space, the cockroaches, and we're seeing kind of day in, day out, there seems to be another story, more spotlight on some of these private credit lenders and some of the tensions, some of the cracks, some of the fissures. Do you worry about contagion risks?
Not really. It depends on how much you're asking me to worry. Is there going to be, or am I worried to the point that, is this like 2007, 2008?
Yes.
Is that like a systemic crisis? No, I'm not going to give you that headline, right? No.
Why?
Because the point is, right? Why? I don't. Look, I guess.
Why not the headline? Why are you a little bit more sanguine?
A bit more sanguine, right? So, look, I think when you look at actually on an index level relative to or compared to the cockroaches stories, that tells you a different story. You know, let's be very honest. The way you get people scared is by saying First Brands, Tricolor, Blue Owl, right? You give them the single name stories. The way you don't get people scared is to say, look, if it's going to be systemic, we're going to have to look at the aggregate numbers, right? Because it's not like one or two or three single name stories. Because let's be honest, there's always some single name stories. They come and go, like once a month or once every 2-3 months, right? And then people forget about them. But let's say when we go back to First Brands and Tricolor, who still talks about that? No one. And in November it was like, oh, this is how it started in 2007. And we had numerous of those examples since COVID. But if you look at an aggregate basis, you look at private credit delinquencies, you look at bank loan delinquencies, you look even at public credit and public high yield delinquencies, they've all been going down in the last year and a quarter, the last sort of 15 months. They've actually started to trend down. If you had asked me sort of summer 2024, the lines were doing this. Now, obviously, I would have said, yeah, you know, I don't think it's going to be that bad. But in actuality, I wouldn't really have had a proper answer why I think that is the case. Maybe because rate cuts, but actually what we are really clearly now seeing is the effect of rate cuts, that lagged effect of rate cuts is now coming through in the delinquencies. Look at private households. Even credit card delinquencies are starting to go down. So on an aggregate basis, things are actually starting to be better. That's number one. Number two, very quickly, is if you look at private credit, the absolute growth in the last particularly 5 years, phenomenal, but we're coming off a base that's extremely low. Bear in mind that if you look at the total volume of private credit relative to bank loans just in the US is 3%. right? So 3% private credit relative to total bank loans. That's not big enough to create a big sort of systemic issue.
But is it a selling point for Europe that it doesn't have as much exposure to tech?
No, I don't think so, because you look at Europe, again, do I want to lean into that right now because it's got more cyclicality? Yes, right? Do maybe some of the private credit or private markets names, do some of them have an issue because they have more software exposure, and in that software exposure there might be, you know, some issues lurking? Yeah, maybe. I'm not a single name analyst, right? But what you're seeing right now is when you look at the software sector, it's been sold off indiscriminately, right? You look at the components and every single one has been down. So essentially it was like, if you're a software, you're going to be dead. And that is too much. There are some companies, right, if you look at IGVs, there are some companies in there that are literally running a monopoly-style business model. Yeah. That's too much to not have any sort of differentiation between them.
So, Max, when we see news reports, and we might get more of these, to your point about, you know, we keep hitting people with these individual company stories. So when we get more stories of BDCs, these are the business development companies that do direct lending to software companies, and we'll see more of them reducing payouts to their owners or decreasing the value of their portfolios, especially if they've got lots of software exposure. Do we just put that in a bucket and say, well, that's interesting, just in the same sense that corporate earnings are interesting, but it's not a canary in a coal mine?
I don't think it's a canary in the coal mine. No, again, because the volume, the total volume is too small to really create the systemic issue. That's one. Two is, I think it's probably a sector-specific thing. Is that something that will flow through into, you know, the big banks, the regional banks? No, not really. In fact, you know, look at the regional banks. Look at KRE over the last 3-4 months. It's been massively outperforming. Right, and rightly so, because people are now saying, hey, you hold on, like, actually, is that something that will flow through into the banking system more widely? No, it's too small to matter. And in fact, we are starting to see, not only on the private household side, not only delinquencies, credit card delinquencies and all that going down, but you're also starting to see on the household and on the consumption side, you're clearly starting to see that the lower end of the K is starting to do better. If you look at private household consumption, the low-income earners are starting to actually have consumption a bit more up. And that is what's probably a little bit more important for the wider banking sector overall, where it's a bit insulated then from the BDCs and all that.
Max, thank you very much. Thank you for your time. Max Kettner, Chief Multi-Asset Strategist at HSBC. Coming up on the programme, we'll return to the corporate earnings stories. The autos component manufacturer Valeo reported earnings this morning. We'll be speaking to the CEO, Christophe Périllat. We'll talk about Chinese competition, perhaps, in the state of the European car industry. That interview is next. This is Bloomberg.
Happy Friday, everybody. This is the opening trade. We're 30 minutes into today's session, and this is the picture in European stocks this morning. Pretty tepid, actually, in the open. We're having weakness in Paris, but the outperformer this morning is the FTSE 100. That corresponds with the sectoral picture. We've got basic resources leading the gains, and copper set for a second weekly gain at the moment. This, in contrast to the US futures picture, a little more negativity set to come out stateside. Later, of course, we've got those US PPI numbers dropping this afternoon, London time. But Tom, what are you watching under the sectoral?
Yeah, look, Lizzie, to your point, it does feel like a European equity market that is looking for the next catalyst, but within the context that we're still close to those record highs. So volumes versus the 28-day average, a little bit higher in the Friday session today, up about 5% versus, again, that 20-day average. In terms of the breakdown, in terms of the members on the upside versus the downside, you talked about basic resources as a sector. That was the number that we were looking at. In terms of the breakdown, individual names, Siemens Energy is gaining 1.5%. It's got that exposure, of course, to data centres, and they're going to be paying a dividend of €70 per share. In the medical space, Roche gaining 0.7%. Swiss Med approving Roche's treatment for lupus, so that's lifting that stock, it seems. In the mining space, it's interesting, you've seen a pop up again in terms of copper and silver in the session today. Glencore is gaining on the back of that. Broadly, you're seeing a lift for the mining space on the back of copper prices and silver. On the downside, it's the exposure for banks, and particularly the likes of Jefferies, Santander, and here in the UK, Barclays, to that collapsed UK lender MFS. So Barclays down 1% on that exposure, potentially $400 million or thereabouts. Teleperformance, this is a potential hit on the AI story. They had softer first quarter forecasts. They're looking at revamping the leadership, down 7% there over in France. So that is a pressure point, certainly, in terms of the tech space. BASF, major chemicals maker, has major exposure to China. Based, of course, in Germany. Results showing that there is cost-cutting, there is that chemical slump that continues, price pressures, of course. The energy component is a challenge for BASF, currently down 1.6%. Anna, what else are we thinking about?
Yeah, let's turn our attention to some geopolitical news themes this morning. Pakistan's defence minister has declared, quote, open war with Afghanistan after both sides carried out cross-border strikes overnight that killed dozens. Tensions have steadily risen between the neighbours since the return of the Afghan Taliban to power in 2021, with Islamabad blaming Kabul for hosting militant groups that plan attacks in Pakistan. The Taliban denied the accusation. Prime Minister Keir Starmer's ruling Labour Party has lost a formerly safe seat in the UK Parliament, finishing third behind the Green Party and Reform UK. The Green Party won the special election for the Manchester seat, with candidate Hannah Spencer securing 41% of the vote. Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch its $111 billion deal for the historic Hollywood studio. Netflix said that while it believed its deal would have passed muster with regulators and created shareholder value, it didn't want to keep on bidding. Tom.
Let's get back to the earnings space right now and focus in on autos and that sector. Autos component manufacturer Valeo's fourth quarter revenue beat estimates as the company engaged with its cost reduction plan. The French car parts supplier's full-year sales came in at just shy of 21 billion euros. Very pleased to say we're joined now by the company's CEO, Christophe Périllat. Christophe, good morning. What should investors take from these numbers and these earnings, and how it positions the company going forward in a sector that, of course, has been challenged?
Well, for sure, the sector is challenged. Good morning to all of you. I think it's a very solid result. In 25, the sales are up like for like. The operating margin is up. The free cash flow generation is up. The net result is up. So, I mean, it's another step of improvement of Valeo. We have done this, since 22. We are delivering what we are promising. And on top of that, we have issued a positive guidance for 26. Stating that we will continue to make progress in 26 on profitability and cash generation. So overall, it's a solid year, and it's a year where we are continuing to make sure that the years to come are going to be okay, because we have good order intake, good orders that we receive from our customers.
Mm-hmm. Christophe, the China market is still underperforming for you. When does that turn around?
It's going to turn around in H2 of 2026, where we are expecting growth to come back. And then we plan to outperform the market as of, the following year. China for sure is a very important market. As you know, it's an important market for Valeo as well. We have 50% of our sales there. We are a strong supplier there. Competition is strong, but we have the competitiveness, we have the technology. And, one of the most important number, I think, in our release yesterday was the amount of orders we are receiving in China for the Chinese OEM. In 25, it was, in total worth 2.8 times our sales. So we are going to grow again in China with the right customers, with the Chinese OEMs, and there are proof points of that in the orders we received from these customers last year.
Christophe, good morning. It's Lizzie. What are your thoughts around chip availability this year? Some are warning that you could be pushed further back in the queue because of the need for chips for data centres. How are you planning around that when it comes to EVs and software-defined vehicles, which of course need chips?
Well, the subject is really on memories, where there's a competition between all the industries, the consumer industry, the auto industry, and the data center industry. What we're hearing from, the memory suppliers is that, they're going to protect the auto industry. This is what they said. And I think it's linked to the way, the auto industry is giving good forecast and reliable forecast and stable forecast to these suppliers. So this is what we are hearing from them. Of course, it's a day-to-day battle to make sure that we have the right quantities. We're working with our customers, working with, our suppliers, and let's see what happens next.
And how are you planning more generally around heightened geopolitical risk?
Well, probably the best way of handling them is to have, a local for local strategy. And this strategy has been helping us, for instance, to navigate through the different tariffs that have been implemented here or there. We are North America. We are a North American supplier in North America. We are a Chinese supplier in China. We are a European supplier in Europe. We are operating where our markets are. And, when there's so many forex variations, geopolitical, issues, I think this is a very strong protection for our operations.
Good morning to you, Christophe. I wanted to ask about the European side of things and whether you have any expectation or think it's important that in Europe, that European companies have some pressure on them, I suppose, to use European suppliers. Is that something that you're expecting European regulators? The EU is considering adopting some kind of rules around European preference. Is that something that you would welcome?
For sure, we are a promoter of this idea for a very simple reason. Let me remind you, and I said it before, that we are very strong in China. And China is the main country of Valeo. But we are doing in China, we are manufacturing in China what we sell in China. And we believe that's the right thing to do. We don't intend and we don't want, to produce in China and then deliver to Europe, because this would be detrimental to the European economy and to the European jobs. Now we have to, recognize that, China is 30% more competitive than Europe. This is just a fact, and we have as well to recognize that the, European auto industry is the main industry of Europe and worth 7% of GDP. So there's a real question, about how to protect the European industry. When it comes to the auto sector. And then you look around and you see that, in India, 80% of local content is required. You look at North America, 75% of local content is required. You look at China, 95% of local content was required. And that was not a requirement for Europe. So yes, I'm a promoter of a minimum level of European content on European cars at the level where it is today. Today, a European car has, in average, 75% local content. So it's the time now for, the policy makers to decide whether they want reindustrialization in Europe or delocalization outside of Europe. And let's see. I'm, optimistic about what's going to be decided. I think the next. The next step is going to be March 4th, where the European Commission will reveal its plan.
Okay, very interesting. The choice possibly facing the industry and regulators in Europe. Christophe Périllat on the results, of course, CEO of Valeo. Those earnings coming in broadly in line with expectations. Stock down about 2% so far in the session. Coming up, we were talking there about the chip shortage. Researcher IDC says the global smartphone market, ties in, will contract this year, but by how much? It's quite startling. The answers when we come back. This is Bloomberg. Before the break, we asked, by how much does researcher IDC see the global smartphone market shrinking this year? The answer is 13%. The researcher says this is due to the unprecedented memory chip shortage, marking what it calls, quote, a crisis like no other. IDC now sees just over 1.1 billion mobile shipments this year. That is down from 1.26 billion, almost 1.3 billion in 2025. It says memory chip shortages have made cheap phones a thing of the past. Premium handsets, like the bulk of Apple's iPhone lineup, will weather the crisis better, they say, though companies like Xiaomi and Lenovo have warned that consumer prices may have to rise. It is therefore unlikely to impact Anna Edwards' gold and diamond bezel edges iPhone 17, Anna.
That's definitely the way I roll, Tom. But it does tie into the conversation we were just having, doesn't it, Lizzie? Because we were talking to Valeo about chips for cars. And if chips, there's just a lot of competition for chips and everyone's having to pay more for them. And what does that mean for the car sector? He said that their supply is going to be protected. But, you know, when we speak to lots of different sectors that need their chips, they all say they have good relationships with these chip suppliers and they are the ones who are going to get those chips. But lots of tech themes, including CoreWeave.
Yeah, do you know who buys a lot of chips? Yeah, CoreWeave. They buy a lot of NVIDIA's GPUs and then they lease them out to the hyperscalers. So there was a bit of a shudder in the markets on the back of what CoreWeave was saying in terms of the capex it has to spend, coming in at 30 to 35 billion US dollars. The losses came in heavier. They're borrowing a lot more. What they're saying, CoreWeave, is that we see massive demand. We have to build for that. But clearly that comes at a price. And so that was one company that felt a bit of pressure. On the other side, Dell seeing some gains because of their exposure to data centers.
Is it just that they're at different stages? That you've got CoreWeave at the capex prove it stage and Dell at the ROI proved stage.
Different business models as well, aren't they? The different, you know, maybe different stages, but also different parts of that data center supply chain. And we're having really interesting conversations, sort of discovering where the money gets made.
Should we get more in terms of what's happening in data centres? And another angle on this, because some breaking news this morning was around what is happening with Equinix and the Canada Pension Plan Investment Board teaming up with Equinix and agreeing to acquire AtNorth. That is a pan-Nordic data centre operator owned by Partners Group Holding. The deal valuing the Iceland-based AtNorth at $4 billion, including debt. Joining us now, very pleased to say, is Regina Dahlstrom, the Equinix Managing Director. Regina, good morning. Why does this deal make sense for Equinix?
This is about meeting the rapid growth of digital infrastructure need in the market. And combining the Equinix global interconnected platform with the high-density, high-capacity, IA-ready capacity in all 5 Nordic countries of AtNorth is a magic combination. And I think we will have a very strong position meeting this market demand ahead.
And it means that you're essentially adding potentially eight data centres with more in the works as a result of this deal. What is the level of demand you're seeing right now, and how does it break down in terms of enterprise, AI, the hyperscalers? What is the demand picture looking like right now?
The demand picture is, like you say, it spans over all of those. So there's AI demand for sure, but underlying is still the digital transformation of our enterprise segment, which requires services to cater to sovereignty, security, resilience, and then in combination with the AI workload placements that also in their turn needs connectivity. So I'd say it's a healthy mix of both, and they interact with each other and want to be placed nearby each other.
And Equinix, I should say, has enjoyed a bull run in the share price. Regina, good morning. So is it about, hence this M&A currency, is it more about organic growth from here, or have you got other targets in mind? Where else would you look maybe for the next acquisition?
Now, I'm focused on the Nordic and framing this organic growth with the Nordic attributes. And I think we have a healthy pipeline to continue to build on our decades of growth in Equinix. And so we will. So looking ahead, we have 800 megawatts of capacity in the AtNorth platform to start to work with when this deal is closed. And we will, and we foresee future decades of healthy growth ahead organically within Equinix.
I am interested why you see a competitive edge for Nordic data centres over other locations and how the geopolitics feeds into all of this, because, of course, you've got the proximity to Russia. Do clients ask you about resilience on that front?
Definitely, and I'd say that the Nordics stands out more than ever in terms of being prepared and resilient. I think the attributes of the Nordics to its renewable energy, its sustainability agenda, and high degree of tech innovation stands out further. And then the preparedness and the resilience of the region has become more of a positive, I would say. Yes, there has definitely been highlights of the infrastructure in terms of the geopolitics, But I would say that the Nordics stand stronger than ever.
And it's also nice and cold, which possibly helps, Regina. Let me ask you about data centre construction. We've seen anecdotally, or maybe more than anecdotally, reports that sometimes you can't build data centres fast enough in the States, sometimes because of a lack of workers or a lack of building materials rather than anything much more tech. How would you rate Europe's experience? What's been your experience watching the data centre build out in Europe?
I think this is what's so impressive with AtNorth, who have, in a very efficient manner, used, I would say, many of the benefits of the Nordics, the skilled workforce, the cooperation with local authorities and power companies, and have done a fantastic job in building very quickly without compromising on quality, security, or sustainability. So I think, again, the Nordics, and in this case AtNorth, really proves the point that you don't have to compromise on anything building data centers in the Nordics and deliver definitely the highest grade of all these attributes in terms of efficiency, sustainability and quality.
OK, so those attributes are at play in the Nordics. We've been talking a lot this morning, whether it's the car sector, the auto sector or smartphones, about the lack of chips, I mean, particularly high bandwidth memory. And we know that a lot of that is going into data centres. Are you seeing, is that a constraint? What is the impact on your business? Are you seeing that impact?
So this would be our customers, and no, we don't see any indication of a demand, of less of a demand or anything similar. So no, from our point of view, our customers still seem to have ambitious plans of growth, and we have a healthy pipeline of our customers' demand into infrastructure capacity.
Regina, thank you very much. Thanks for joining us. Regina Dahlstrom, Equinix Managing Director. Thanks for giving us your time this morning. Let's widen our focus onto the broader markets. Adam Linton is with us from our Markets Live team. Adam, good morning. So one of the things that happened this morning, we got some French inflation data, and it came out a little stronger than expected, which kind of doesn't fit with the narrative that we've been talking about in Europe recently, that inflation, Europe doesn't have much of an inflation problem to worry about. It's pretty much it's been at target. So this is just France. But we did see a little bit of a pop-up in the euro on the back of that. What are you thinking about the inflation picture?
Yeah, I think for France, a lot of that has been attributed to what we've seen in the energy markets. I think, it doesn't really change the broader picture of what we're seeing for Eurozone inflation. It was particularly soft last month. It came in 30 basis points below the ECB target. And I think in terms of the broader ECB, conversation, we saw upgrades to inflation forecasts in December, which kept them in their good place, their happy place, and confident that rates will need to stay unchanged. But, I think there's a possibility that March we get a downgrade to some of those forecasts. And if we do, the conversation could then move on to the possibility of rate cuts. But I don't think that there's really alarm bells ringing in Frankfurt at the moment. Typically, when the ECB cuts rates, there's some sort of growth shock, there's some sort of financial distress, and we're just not seeing that at the moment. If anything, we're actually seeing the opposite. We saw those German PMI numbers last week. That was the first expansion, I think, since 2022. Potential for more to come, given the stimulus effects. I don't think there's really an argument, from a growth perspective or even an FX perspective. The euro's come off about, 2 handles since February, and even at the time, Lagarde wasn't really, concerned too much. So, yes, there's scope to reprice more dovish direction, but not necessarily alarm bells yet.
Adam, how are you interpreting the market reaction, small as it may be, to the UK by-election result? I've got the pound in front of me up again by 0.1%, so nothing to write home about. And when you look at the gilt market reaction, really nothing when it comes to the 10-year, but the 2-year yield down a basis point. What do you read into what the markets are saying?
Yeah, I think the market's obviously clearly shrugging at it at this juncture. You have by-elections are lost by incumbent governments all the time. They have their own idiosyncrasies. But, with UK politics, there's not always necessarily an immediate reaction. We often see things cascade in UK politics. We saw that recently, the Mandelson affair. It kind of came out. Then we saw a few days later McSweeney resigned. Then we saw the Scottish leader called on Starmer to resign. And that's when we really saw the market get moving. So, be on watch for what happens in UK press this weekend, depending on comes out and briefs against Starmer. But ultimately, I think, a lot of commentators are more confident that May will be a more opportune time for any potential candidate to mount an attack on Starmer. And then at that point, that's when the market may need to begin pricing what comes next.
And it sounds like you think Reeves can pull off making the spring statement a non-event in the market.
I think so, yeah. I mean, the UK's finances are, shored up, but, not so too surprising if you increase taxes on everyone. That was, not so too surprising, but risks definitely remain ahead.
Adam Linton, thank you very much indeed. From Bloomberg Markets Live team, of course. Have a great weekend. Adam, talking of the weekend, here's what else to be thinking about over Saturday and Sunday then, and to whet your appetite for some of the activities across Europe. The Milan Fashion Week is getting underway. Art on Ice, Zurich, whatever that is. Comic-Con London, Lizzie's going to be there with her best cosplay. And German football rivalry, Borussia Dortmund versus Bayern Munich. Oh, that's going to be good. And the Cricket World Cup as well. Interestingly, the Premier League is going to start streaming in Asia.
Yeah, in Singapore specifically.
Yes.
So, yes, but it's really a dramatic development, very small and contained. It's Singapore, not the world, but it is a really interesting test case, isn't it? There was no Premier League football on the weekend. There is plenty of it, of course. We didn't have it on the graphic, but this is a really interesting test case, because if they can go direct to consumer in Singapore, test it out there, work out what people will pay for it, and then see if they could do it elsewhere, that'll have lots of TV execs a bit nervous.
I always wonder if you're a TV or a rugby man, Tom. Guy's clearly a rugby man.
A TV or a rugby man?
Sorry, a football or a rugby man.
Somewhere in between, yeah. I'm an Arsenal fan, and the World Cup, Rugby World Cup, I'll watch that. Yeah, the Six Nations gets my attention.
No rugby this weekend, though. No. So Mark Cudmore is bereft.
Yes,
Guy
he
is probably bereft wherever he is right now. He will not have the rugby to watch, which I'm sure.
There's the Cricket World Cup. There's the Milan Fashion Week.
Andrea Felsted's in Milan for that.
Excellent.
Is she our fashion guru?
She's not taking you there, Lizzie. I feel this is an oversight.
My time there has been and gone.
So there is no Rugby World Cup to watch, but instead we offer you Bloomberg this weekend on Bloomberg TV. So this is a new show. David Gura, Christina Ruffini and Lisa Matteo. If you don't get enough of Bloomberg TV 5 days a week, then you now can tune in over the weekend. They'll bring you those conversations that could set you up, of course, for the following week in markets. Lots to watch and listen to, whether that's on Bloomberg TV or on radio. You can also access it on the Bloomberg Business app. There we go, promo done. Looks exciting. That is it for the opening trade. The Pulse is up next. This is Bloomberg.